Hey everybody, what's going on? It's James here, and the last video got quite a bit of interaction, so I thought I'd sit down this Saturday afternoon and shoot a new one. This is a potential theory that I have on the QQQ, right, on the tech stocks. And I would say if I had to put odds on this, I would say I'm about 50-50. All right, so 50% chance this is what's happening, 50% chance it's not. That's my personal opinion. So to me, when I look at this, it looks like obviously depression, disbelief, those are really easy, right? Those aren't really up for debate. Almost anybody that looks at this is going to agree this was depression and disbelief. That's fine. That's where things start to kind of, go different directions depending on the camp that you're in. And then this phase through here looks to me like thrill, right? It looks like we're starting to get some of these shakeouts, and it looks like we still have a blow off top stage or a euphoria stage to go. That being said, the blow off stage of a market cycle often goes further than anyone expects. It's nearly impossible to predict where it stops at. So even if I'm right about this being thrill, getting ready to move toward euphoria, it's absolutely possible that the QQQ doubles from where it's sitting at today. It's a runaway train, and I'm not personally a fan of standing in front of trains. I want to wait for the train to stop on its own, or at least slow down, so that I can try to time when it's going to turn. Some other fun charts that I've been looking at. This was one I was looking at yesterday. This is silver versus gold. And it's always interesting when you look at these things, because from the outside, when you look at a US dollar chart, it seems like things just stop in random areas. Like it's very difficult to figure out why did XYZ stop at this specific price or this specific point. But then when we look at something like this chart, measuring silver versus gold, we can see that what actually happened on this pump so far this year, it literally tagged its trend line that went back, 45 plus years. Like this trend line goes back to like 1980, and it just tagged it. So it'll be interesting to see how that plays out. When I was looking at that silver versus gold chart, it got me thinking about, what does silver versus Bitcoin look like from that angle? And so I did pull up a chart of that as well. And that's what this chart looks like. Now, this lacks the volume confirmation that I would really like to see. If I was going to feel strongly like 70-80% on this, I would need like some really good volume confirmation. It doesn't have it. So I think this is probably more like maybe 40% is where I would personally, like, if I was, I'm not saying me, if I was trading this and there was a way for me to, trade the spread between silver and Bitcoin, I would probably be looking for reward to risk ratios that would work, with a 40% win rate, or even potentially as low as 30%. I would want to have some really good asymmetric risk. But I did think this was interesting. It does look a bit like accumulation. Looks like we were potentially in a spring phase. So again, this is silver versus Bitcoin. So if this plays out, it means that silver will gain ground versus Bitcoin. And there's multiple ways for that to occur. Both could go up and silver could just go up more. That's one scenario. Um, you know, Bitcoin could stay flat and silver could go up. Bitcoin could fall and silver could stay flat. They could both fall, but, Bitcoin could fall more than silver. All those scenarios are going to make this, chart show an increase or a movement, an ascending type of movement. So that's one I'm going to be keeping an eye on. Full disclosure, I've been invested in silver since March of 2020. I bought my first silver in 2019. I bought it for my daughter. And then personally, as an investment, I took on silver in March of 2019. So I've been holding it for several years now. I've taken profits on, I don't know the exact number. I want to say about a third of the silver I sold, but I'm still holding silver as a long-term hedge. Not so much as an investment at this point that I'm trying to, get out of the top. If that was the case, I would have been selling more at $100 an ounce. But just as a long-term hedge in case, fiat gets really silly and inflation gets really, really bad. I want to have some precious metals to kind of hedge against that. Just like even as a bear, I still keep a very small percentage of my portfolio in cryptocurrency, because while I'm not a believer in it and I think it's likely to go down, I still want to have that hedge in case I'm wrong. And I want to, have some precious metals. I want to have some cryptocurrency. And so that if fiat goes like really, really badly, that, it's going to obviously erode a big part of my net worth, but I'm still going to have the ability to live. And that's really the important thing. So I'm not chasing gains on crypto or chasing gains on precious metals as much as I'm just insuring myself against a fiat collapse, which I think is extremely unlikely. But again, I also think I thought it was unlikely that I would die in my 20s, and yet I still have life insurance for the very same reason, just covering all of the the basis there. Looking at this chart here, I'm going to pull it up for you. I've talked about Bitcoin versus gold in other videos. One thing I hadn't talked about previously was how the long-term VWAP, or the volume weighted price, is actually sitting down here. So it's, about a 70-ish% drop from where we're at. It didn't quite get there in the 2020 bear market or the 2018 bear market. And so, maybe it gets front ran again. Obviously, it did get there, in older markets, but we'll see what happens with that. It's one to keep an eye on. I also thought this chart here was really interesting. This chart is an Nvidia chart versus Bitcoin. And again, it's so interesting to me, at least. This is the nerd in me, I'm sure, but to me, it's really fascinating to look at these charts because everyone sees Nvidia going bonkers right now. And of course, everyone understands it's because of AI, right? The chips are there's a fundamental driver there. But what's interesting is when you look at this chart of Nvidia versus Bitcoin, the accumulation period, and there is volume confirmation on this one, even though it's not showing on this specific chart, the accumulation period actually started way back in 2013. This initial drop here was in 2012, and then our drop here, the selling climax, was actually in 2013, and then it spent over a decade consolidating, right, before having what I view as a wick-off spring in 2021, about 8 years later. And now we are in 2026, so almost 13 years of accumulation. And that's really interesting because if this plays out, then Nvidia is actually set. You got to think, if this plays out, Nvidia is basically right here in phase D right now versus Bitcoin, which means it still has its markup phase. It has not actually started markup. This is still all accumulation. And again, that happens kind of like with silver. Nvidia could go way, way up, and Bitcoin could also go up, but not as much. Nvidia could go up and Bitcoin could go down. Bitcoin could stay the same. And Nvidia, there's a lot of different scenarios where this happens. But essentially, what this chart implies is that Nvidia is going to be a better investment than Bitcoin. And the reason that's so wild and so crazy to me is because I personally think Nvidia is horrifically overvalued. And so when I look at Nvidia and I say, well, Nvidia looks strong versus Bitcoin, but Nvidia looks weak versus the US dollar, weak in terms of overvalued, right? Obviously, it's got a lot of bullish momentum with it. But when I look at that, it's like, gosh, if I think Nvidia is going to fall, then that leans me to believe even more strongly that Bitcoin is going to also fall, but fall even worse than Nvidia, which is really crazy considering I think Nvidia is due for a pretty rough correction. If I just pull up a regular Nvidia chart, I mean, let's really, really take a look at this thing, get Gravitator off of there and just look at a pure chart. We'll put it on a quarterly chart, so 3 months candlesticks. And when we look at this thing, this is wild. Look at this. From 1999, which obviously is a long period, this thing is up 632,000%. All right, that's insane. Basically, for every dollar you put in back here, not counting dividends, you'd be up around $6,300. So obviously, pretty much anybody who invested back here, a couple $100, couple $1,000, you're talking about the opportunity to be multimillionaires. Pretty crazy. When we look at this is actually a log chart, though. It gets even more ridiculous when I put it on a regular chart. Now look at this. Anybody who looks at that and says, well, that's not a bubble, I think they've been drinking the Kool-Aid a little too long. Again, it doesn't mean that it's going to automatically crash this month. It doesn't mean it's going to crash this year. That bubbles are very, very difficult to call. When Warren Buffett moves into cash, which I mentioned in one of my previous videos, the big critique is, yes, but he often moves into cash and he's in cash for years before the bubbles pop. Right. Totally true. Jeremy Grantham is the same way. They're often not, perfect timing. They're not getting the bubble the month before it pops. They are often early, but what they're betting on is that the market will eventually retrace and correct. And so like in the case of Nvidia, if we even just go from this move, which it's probably going to be more like back here, but if we go from this move, just hypothetically speaking right now, it's 80% retracements at $51 a share. And so even if I'm selling right here and expecting it to go here, and then let's say this thing gets really squirrely and decides to double from $208 or $212 a share at its high to, let's say it goes to 400. In fact, we'll just type it in so it's a little easier. 400. So let's say that it doubles in some kind of, ridiculous blow off top. Again, if it retraces to the 80% level, which is typically what happens in markets, that's going to put the shares around 88 bucks. So if I'm selling at 200 and it eventually retraces to 88, I win. Even though temporarily I look silly because it went much higher, eventually I win. But I think it's important to point out that there's a lot of people who have held Bitcoin and done really well. And I'm not saying that, there's anything wrong with that, but this is what's called survivorship bias. Right now, it looks like they're really smart. Like if they bought at 20,000 and they're still holding and it's 80,000, it looks, wow, look how smart I am. But that's because it's survivorship bias. If Bitcoin, and we don't know it will, and I don't think it will, but if Bitcoin were to go to zero, they would look really dumb. They have no profits locked in. Essentially, when it comes down to these charts, what I'm doing is I'm betting on history. I'm betting on the proven precedent. And the people who are saying this will not retrace, this will not bust, this will not do XYZ, they're betting on a paradigm shift or the idea that this time is different. And it could be different because that's always a possibility. But historically speaking, every time the participants in the market say this time is different, it never has been different. It has always ended the same way with brutal retracements and brutal crashes. Let's say that this goes even more wild. Instead of going from 200 to 400, maybe it goes to $600. And we're measuring it from this low back here. Even if I put this all the way at $600 a share for Nvidia, if it were then to retrace to the 80% retracement, that would put Nvidia's valued around $128, which is still almost a 50% drop from where it's at today, or probably closer to 40%. So from where it's at today, that'd be a drop of about 36.8%. So this thing would have to go. Let's see what happens if it went to $1,000 a share. If this goes to $1,000 a share, then an 80% retracement is right around 208 bucks. So that would be basically today's price on Nvidia. So if I sell today, and I don't have an Nvidia in my portfolio, but if I sold Nvidia today and it went to $1,000, there's still a very high likelihood that eventually I could buy it back for the same amount. Now, if you're a short-term trader, obviously that's like, well, yeah, but you missed the move. But the thing is the people who are making all these claims about buy and hold, they're not traders, they're investors. They're looking at the long-term value of the asset. So it doesn't matter how high it goes, right? It doesn't matter if it goes way up here, if it then comes back down here. A really good example of this type of bias is when you look at AMC. So there were a lot of people who thought they were geniuses because of the money they made on AMC. I actually saw a post I made on social media on January 21st of 2021. It was actually this candlestick right here, right? This monthly candlestick. I made the post around $4 and something. Now this stock is split and everything, so the prices are different now than what they were then. But essentially I made the post right around the top, the breakout of this red candle, okay? And within days, this thing actually pumped, over 300%. And within, months, it had posted, it had pumped thousands of percent. And there was a lot of people, like when I got out of my AMC, there were people that were like, that's really dumb. It's like, it's going blah, blah, blah. It's going this high. It's going that high. And of course, now AMC is down 99% from its highs. Okay. Ironically, I did buy AMC back. I took some of the profits I made, and when it fell back to that level, I just bought it right back. And so I am underwater like hugely on that purchase, but it was all profits from the move up. You don't know until hindsight. So many assets have looked really, really good. Look at Enron, right? Nobody thought Enron was going to crash, but it did. Look at the housing market. Back in 2007, like most people were convinced it could not crash. In fact, there was big talking heads saying that it had never crashed and it couldn't crash. And then, of course, it turned around and crashed. Side note on the housing market, I think it's dangerous. I see a lot of people in social media pushing the idea of not buying homes and renting homes because they're like, this is going to crash, this is going to crash, this is going to crash. I'm not a housing market expert, but just from an economic standpoint, it's weird to me that people think the housing market is about to crash because we have a major supply issue. There are not enough homes to house our population. And so essentially the only way it can crash is to drastically increase the supply or drastically reduce the demand. That's just basic economics. What happened in 2008 was a lot of builders went out of business and they never came back into the industry. And I know that firsthand because my father-in-law built homes for over 40 years and he lost his job during that recession, right? And it was really tough in that field for a long time, and it still hasn't recovered. My oldest stepson is a foreman in a construction company. And, we talk about this on a regular basis because we also have, a side business together that, I put the finances up for, and he's the one that's the boots on the ground, and it's in the construction industry. That industry still has not recovered. There's a serious, serious supply issue. And so I don't know that the housing market is near crashing. And if you think about trying to time that, and you're renting for, a year, 2 years, 3 years, 5 years, that's money you're just throwing away. Whereas if you buy a house, at least you're building equity in that house. I know people are like, well, yeah, but then when it crashes, you're underwater. True, right? True. But I would say it's important, if you are going to buy a house, maybe try to buy a house that you're going to be in for a long time. Like I bought my house in '08, right? I bought it when the market was beaten up really badly, and I bought it almost 20% under asking price. I was very, very hard nosed in the negotiations. And let me do the math in my head so I'm not lying about that number because I don't want to exaggerate. So I bought it about 14% is the number, 14% under asking. In fact, my offer was so low that my real estate agent refused to take it to the buyer. And I actually had to push the issue that that's like against the law. They have to take my offer to the buyer. And I told them if they didn't take the offer, I would fire them. My original offer was closer to 20% under, and we ended up, negotiating and settling for around 14% under asking, because the house that I bought was 4 years old, but it was sitting empty because the people who owned it no longer lived in it. They had purchased a different home. And so they were just carrying this house. And I knew that they were, in a much bigger hurry to sell than I was in a hurry to buy. I already had a home, right? I didn't have to buy anything. So like really keep in, mind all the economics behind these things. The reason that I'm so bearish on the market as a whole is because at the end of the day, AI is, driving these earnings boosts, and that's what's being priced into the market. People are pricing in all the future earnings, but AI is eliminating jobs faster than they can be replaced. And I do think eventually they'll be replaced, but we saw historically speaking that typically takes decades, right, for new job markets to emerge and things like that, new roles to emerge. And so it seems like a lot of people, a lot of bulls at least, are kind of forgetting, like, yes, let's say Meta and all these companies are making more and more, money, more productivity. Eventually there won't be anybody to buy their goods and services. Like they're hollowing out the middle class, right? And this isn't just a stock market thing. This is like an economy thing. The middle class is being decimated. Like when we talk about economics, I'll use Missouri as an example because that's where I live at. Missouri's minimum wage when I was a teenager was $5.15 an hour. And then it went up to $7 an hour when I was in my 20s, and it stayed there for a really long time. And then I don't know, about a decade ago, maybe 8 years ago, it went up to $10 an hour, which I thought was crazy. And then when COVID hit, they were like, we just want to destroy the cost of living in Missouri. So it went to 11, 12, 13, 14. And then this year it kicked up to $15 an hour for minimum wage. So now when you go out to eat fast food, it's like $30 for fast food, or it's like $40 for like a Steak and Shake. I don't know if those are a national chain or not. So it's super expensive to eat out. And it's because the labor costs have went up so much. But at the same time, the people on like the people that were near the poverty level, that actually really helped them. Like they are doing better today in Missouri than probably any other time in my lifetime, right? So the poverty level, those people really that helped them, right? And so there was a really big positive thing of that. The problem is who it didn't help the middle class, right? The people that were already making like $50,000, $60,000 a year, they did not get that 50% raise over a 5-year period. They did not go from $10 to $15 an hour, right? If they're making 25, they're not suddenly making 37. Maybe they're making 25, at COVID, now they're making like 28. So maybe they got like a 10% raise. At the same time, the people in poverty got like a 50% raise. And so the problem is the cost of living skyrocketed more than their raises went up. And so we continue to do this all over the country. Missouri is not an exception, in a bad way. It's actually probably better here than in most areas. Of cost of living in Missouri compared to the country as a whole is much, much better. But just compared to 5 years ago, it's gotten a lot worse. So for example, the medium home price here in Missouri before COVID was like $165,000. And now it's like $240,000 or $250,000. But people didn't get a 50% increase in their income. Only the lower end of the spectrum did. And so as they hollow out that middle class, consumers have less and less money to spend. And so they're projecting these perfect scenarios where productivity goes up and earnings skyrockets, but they keep forgetting somebody has to buy these products. Like Nvidia, most of its, earnings at this point, it's AI related. Like it's not really reliant on the consumer near as much. So there's going to be some weirdness there that's going to be tough to call, obviously. But it's kind of like with Nvidia. There was a huge bubble in Nvidia back in 2018 that I predicted, and it's because at that time Nvidia's growth was fueled by cryptocurrency mining. And when I said at the time was like, there's ASICs coming out that are going to replace these GPUs in the mining world. And I knew that firsthand because I had a mining operation. And so I knew firsthand, like, hey, there's new ASICs coming out that are going to completely demolish, my ability, my hash rate, basically. And so, of course, that's what happened, right? As the demand for those GPUs decreased, Nvidia crashed. It doesn't look like it crashed in hindsight, but if we go back, this was 2018 right here. So when the cryptocurrency market collapsed, Nvidia collapsed 57%. So I really feel like there's a lot of rose-colored glasses going on, and I don't see it, guys. I don't see it. But I also want to mention that a lot of people don't seem to understand this. There's always an opportunity cost in life and in markets especially, and that goes for everything. Let me give you like one example, right? So if the average return of the stock market is 10%, I think some people are getting in their head that because it's went up so much lately that this is the new paradigm. It's not, right? We know historically speaking that the average is about 10%, right? So if the average return on the stock market is 10% and I'm not in stocks, let's say that I'm sitting in something safe like bonds or something, maybe I'm getting 3.5%. So essentially I'm losing 6.5% gains, right? Temporarily for the peace of mind. But what people forget about with this is that 10%, it doesn't look like this. That 10% looks like this. So I can sit in 3.5% and temporarily be quote unquote losing to the market. And when it crashes, I can then move back into that asset at a better value. And then I'm still getting the 10% returns, but I also got 3.5% while I was waiting. Okay. People don't think about it that way. I mean, even houses, for example, like my house is paid for. I don't have a mortgage, but it doesn't mean that it's free. It's not free. There's an opportunity cost. Let's say that hypothetically, I could rent my house out for $1,800 a month. Again, Missouri's a cheaper place. So, I'm not going to get 3,000 or 4,000. Maybe I get about $1,800, maybe 2,000, but let's say $1,800 a month. So what it costs me to live here, not counting property tax, insurance, and all that, it's my wife, it's me, and it's my daughter. So we could go rent a 2-bedroom apartment here in Missouri, a nice 2-bedroom apartment. It's going to be about $900 a month. So it's costing me $900 a month in opportunity cost to live in my home because I could simply rent it, take the money I'm getting from the rent an apartment, and be pocketing the difference. And then we can go even further because I could be taking this $900 a month and putting it into the market. So there's always going to be opportunity costs like that. You've got to like look at it and be like, look, you're never going to get 100% of the opportunity. Like it's just not possible. Nobody does. The idea is you just want to try to get a safe return. And even with Bitcoin, the part that people leave out, they look at it in terms of absolutes, right? Absolute return. They never look at it in risk adjusted return. And the returns in Bitcoin, when adjusted for risk, it's really, really tough to justify that investment, right? Many stocks have outperformed Bitcoin, and those companies, those stocks are backed by real companies with real products, with real earnings, with real collateral, with real intrinsic value versus it being based entirely on extrinsic value. So It's not about bashing anything. It's just about simply saying, look, like, you can play this however you want. And I encourage you to do your own due diligence, and I encourage you to follow your own investment slash trading plan, but just make sure that you're doing it from a point of logical and rational analysis and not hopium, because hopium is very dangerous. And assuming something has to do what it's always done is also dangerous, and that goes for me saying that, hey, I think it's going to retrace 80%. Like, if it doesn't, I'm still okay. Again, because my financial situation is different from other people's. Like, if I don't get to participate in the markets ever again, like as far as investing, that's okay. Like, I will still be okay. Like, if I pulled everything out of the market right now and I never bought another stock and I only invested in bonds, I would still be okay. But that's not the situation that everyone is in. And so you have to do your own plan. You've got to build your own trade plan. Like if I was 20 years old, my trade plan would look very differently than if I was 30. And that trade plan at 30 is going to look very differently than 40. And, it's going to look like if I'm 60, for example, I'm going to be super conservative because I don't have the time. I don't have the luxury of waiting for markets to recover necessarily. I may need that money in the next 5 years. Again, being in my 40s, I'm simply not going to be near as aggressive as a younger person. Like a 20-year-old who went and had $10,000 in their life savings and said, I'm putting $10,000 in Bitcoin in 2020. That's not absolutely the worst idea in the world, because even if they lost it, they're 20, right? They got their whole life to recover from that. But, if you're 50 and you only got 10 grand in your name and you put that in Bitcoin, it's not the same bet. So keep those things in mind. I'll go ahead and wrap the video up there. Please remember, I'm some guy sitting in a spare bedroom. I've been wrong before. I will be wrong again. And that means you should always go out and do your own due diligence and seek out professional financial advice from a licensed financial advisor before making any type of investment in cryptocurrency, the stock market, precious metals, Forex, or any other tradable asset. As always, please remember to trade safe and use proper risk management.